Hello everyone, Ken AG here. Today I decided to record a slightly different kind of video. This isn't technical analysis. This isn't a short-term prediction. And it's definitely not a hype video. It's a direct response to a subscriber, and honestly to a question I know a lot of people are asking quietly to themselves. Here's the question. Ken, should I take advantage of this silver rally and sell? I've seen some friends selling. What's your opinion? First, let me say something important. I read and value the comments. I can't always respond to every single one, but I take them seriously. So if you have a question, a topic suggestion, or even a disagreement, write it. This channel exists for conversation, not a monologue. And if you're not subscribed yet, subscribe now. It helps keep the channel alive, and I'll keep trying to deliver content that makes you think, not just react. Now, the standard disclaimer, quick and direct. This content is educational and informational. It is not a recommendation to buy or sell. Markets are volatile, data can change, and you should always do your own research and, if needed, consult a qualified professional. With that said, let's actually talk. The question behind the question. When someone asks me if it's time to sell, that usually isn't the real question. The real question is usually, did I already make what I was supposed to make? Is this too high? What if it drops tomorrow? What if I lose everything I've gained? That's human. It's not weakness. It's financial survival instinct. And I understand it completely because I felt it too. You watch silver go from $20 to $110, $115, and a voice in your head starts saying, take profits, lock it in, don't be greedy. What if this is the top? So I'm going to answer as honestly as possible. How I think, how I act, and why. But listen, that doesn't mean you have to do the same. Your situation is different from mine. Your timeline is different. Your financial needs are different. What works for me might not work for you. And that's okay. Let's start with the gold to silver ratio. The starting point right now, the gold to silver ratio is around 1 to 46. That means 1 ounce of gold buys 46 ounces of silver. Historically, that ratio has been much tighter. For centuries, it bounced between 1 to 10 and 1 to 15. Sometimes it went to 1 to 20 during periods of relative stability, but the long-term average across human history is somewhere in that 10 to 15 range. Now, an important detail, around the pandemic in 2020, that ratio almost hit 1 to 125. And in my opinion, that was one of the biggest financial gifts of our generation. At that moment, silver was absurdly cheap relative to gold. If you understood what was happening, if you had capital available, if you had the courage to act when everyone else was panicking, you could exchange 1 ounce of gold for 125 ounces of silver. That's an opportunity that comes maybe once in a lifetime. Today, even after this rally, silver still isn't expensive in relative terms. It simply stopped being absurdly cheap. The ratio at 46 to 1 is still historically wide. It's still telling you that silver is undervalued relative to gold. Not as extreme as 125 to 1, but still meaningful. But silver has already run too far. I hear that a lot. Let's look at the facts. Silver today is in the $110 to $115 per ounce range, depending on the market. In January 2024, it was around $20. Is that a massive move? Yes. Is it a 500% gain in roughly 2 years? Yes. But a big move does not automatically mean expensive. There's a huge difference between price going up and value being fully realized. Markets don't price the past. They price future scarcity. They price supply and demand dynamics going forward. So the question isn't, has silver moved a lot? The question is, has silver reached a level that reflects its fundamental value given current and future supply-demand conditions? And my answer to that is no, not even close. Now let's hit the part almost nobody talks about properly. Demand, the elephant in the room. Right now, silver demand is roughly 140 to 150% of annual mine supply, meaning everything mined in a year isn't enough to meet annual demand. Think about that for a second. The market is consuming more silver every year than all the mines in the world are producing. So how is the gap filled? By burning inventories, by draining above ground stocks, by depleting the reserves that were built up over decades. And where does that silver go? Solar panels, batteries, electronics, medical devices, infrastructure, jewelry, coins, bars. About 85% of newly mined silver today goes to industry. Only about 15% goes to investment. That changes everything, because that industrial silver doesn't come back. It doesn't sit in vaults. It becomes product. And in many cases, it simply disappears from circulation permanently. When silver goes into a solar panel, it's embedded in that panel for 25 to 30 years. When the panel eventually gets recycled, recovering the silver is expensive and inefficient. Most of it is lost. When silver goes into electronics, into circuit boards, into smartphones, into medical devices, the quantities are so small per unit that recycling isn't economically viable. The silver is gone, permanently removed from the market. Let me give you specific numbers to make this concrete. A typical solar panel uses about 20 grams of silver. That doesn't sound like much, but global solar installations are projected to triple by 2030. If that happens, solar alone will consume 300 million ounces of silver annually. That's nearly 1/3 of total annual mine supply for one application. And that demand is policy-driven. Governments around the world have committed to green energy transitions. Those commitments aren't optional, they're mandated, which means solar demand for silver is locked in regardless of price. Electric vehicles use about 30 grams of silver per vehicle, more for high-end models with advanced electronics. As EV adoption accelerates, as traditional combustion engines get phased out, automotive silver demand grows structurally. 5G infrastructure. Every base station requires silver. Data centers, every server, every switch, every piece of networking equipment. The digitalization of everything means electronics demand for silver continues climbing. This isn't cyclical demand that can be turned off. This is structural demand embedded in the infrastructure of the modern economy. And here's what most people miss. That 85% industrial consumption means price elasticity is very low. Solar manufacturers don't stop making panels because silver went from $20 to $110. The silver cost per panel went from $14 to $77, but the panel sells for $500 to $1,000. The silver is less than 10% of the finished product cost, so the manufacturer absorbs it or passes it to the customer, but they keep producing. They have contracts, they have installation schedules, they have policy mandates to meet, they need the silver regardless of price. This is fundamentally different from gold. Gold is primarily a store of value. About 60 to 65% of all mined gold goes into jewelry, but that gold stays in circulation. It gets melted down, it gets refined, it comes back to the market. Gold has a very high recycling rate because it's valuable enough to justify the recovery process. Silver, in most industrial applications, doesn't. So the industrial consumption of silver is a one-way trip. Supply leaves the market permanently. The illusion of abundance. There's a popular idea that there's too much silver in the world, that silver is common, that it's not really scarce. That's not true. Roughly half of all silver mined in human history has been drained by industry. It's gone. It's not in vaults. It's not available for purchase. It's locked up in products, in landfills, in forms that can't be economically recovered. If you look only at stocks that are actually available, the ratio of available silver inventory to gold inventory is closer to 4.5 to 1. That means, in terms of available stock, silver isn't 46 times more abundant than gold. It's more like 4.5 times. That's a massive detail the market ignores. That's why I say silver's price is wrong. The market is pricing silver as if it's 46 times more common than gold, when the reality of available supply is completely different. So how high could silver go? Here's a line of thinking I really like, inspired by Warren Buffett. Imagine an incredible company with strong fundamentals, strong cash flow, and a real competitive advantage, trading below its intrinsic value. You don't sell that company just because it's up 200%. You sell when it approaches intrinsic value, when the market finally recognizes what you saw early and prices the asset appropriately. I think about metals the same way. If silver were priced purely by the logic of available inventory, then a 4.5 to 1 relationship with gold would make sense. Not 46 to 1, 4.5 to 1. And in extreme demand conditions, when industrial consumption accelerates, when investment demand surges, when supply can't keep up, even 1 to 1 is not crazy. Gold at 5,000, silver at 5,000. Is that realistic? Maybe not tomorrow, maybe not next year. But is it fundamentally possible given the supply-demand dynamics? Absolutely. That would be more than 1,000% upside from current levels. I'm not saying it happens tomorrow. I'm not saying it's guaranteed. I'm saying the fundamentals allow it, the supply deficit supports it, the industrial demand justifies it, and the historical relationship between gold and silver suggests it's not only possible but likely over a long enough time horizon. Why compare gold to silver? Because they're close relatives. Historically, monetarily, and physically. Most people don't realize this, but roughly 60 to 65% of all mined gold goes into jewelry. If gold gets too expensive, the market adapts. 18-karat jewelry becomes 14-karat. Jewelry gets lighter, or it becomes silver. That's called price substitution. When gold becomes unaffordable for certain applications, silver steps in as the alternative. Silver benefits directly from expensive gold. And we're seeing that dynamic play out right now. Gold at $5,000 per ounce is pricing out a lot of traditional jewelry demand in developing markets. India, China, Southeast Asia. These are cultures where gold jewelry is deeply embedded in tradition. Weddings, festivals, savings. But when gold becomes too expensive, what happens? They shift to silver. They buy silver jewelry. They buy silver coins. They preserve the cultural practice, but at a more affordable price point. Derivatives, the time bomb. Now comes the uncomfortable part. There are serious estimates suggesting there are 300 paper silver contracts for every 1 ounce of physical silver. Some estimates say 1,000 to 1. Let me put that in perspective. For every actual ounce of silver that exists in deliverable form, there are 300 to 1,000 paper claims on that silver. Futures contracts, ETF shares, allocated accounts that might not be truly allocated. Unallocated accounts that are definitely fractional. That's not a market. That's extreme leverage. It works until it doesn't. As long as most participants settle in cash, as long as delivery requests stay low, the system functions. But if sentiment shifts, if a significant percentage of paper holders demand physical delivery, the system breaks. There isn't enough metal to honor all the claims. And when that realization hits, when the leverage unwinds, the repricing is violent. We've seen this pattern in other markets. Nickel on the London Metal Exchange in 2021. A short position that couldn't deliver. The exchange suspended trading, canceled trades, changed the rules. Chaos. The same risk exists in silver, but on a much larger scale, because the leverage is much higher and the market is much more critical to industrial supply chains. Supply doesn't help either. Another under-discussed detail. About 75% of mined silver comes as a byproduct, mainly from copper, lead, and zinc mines. And those mines are dealing with lower grades, higher costs, more regulation, more depletion. You don't ramp silver production just because the silver price went up, because the mine isn't a silver mine. It's a copper mine that happens to produce silver as a secondary output. The economics are driven by copper, not silver. So even with silver at $110, $115, you're not going to see a massive increase in supply. Silver supply doesn't respond quickly to price signals the way a primary commodity would. It's structurally constrained, and that constraint is getting worse, not better, as ore grades decline and extraction costs rise. A perfect storm. So what do we have? Rising demand from solar, from EVs, from electronics, from infrastructure. Inventories being drained at 140 to 150% of annual mine supply. Rigid supply that can't respond quickly to higher prices. Irreversible industrial use that permanently removes silver from circulation. Excessive derivatives creating massive leverage. Short-term manipulation through paper markets. This isn't a normal bull market. This is a structural misalignment that's been building for years. But what if it drops tomorrow? It can drop. It can rise. It can go sideways. Short-term is noise. I don't look at the daily chart to decide my thesis. I don't panic when silver drops $5 in a day. I don't get euphoric when it rises $10. I look at fundamentals. I look at supply. I look at demand. I look at inventories. I look at industrial consumption rates. And those fundamentals can be ignored for months or even years, but they're never ignored forever. Supply and demand is ruthless. Eventually, reality asserts itself. The personal and honest part. Let me be direct with you. I took years of being mocked for talking about silver. Years. People laughed. People said I was a conspiracy theorist. People said silver was a dead asset, that it would never move, that I was wasting my time and my money. Family members questioned my judgment. Friends thought I was being paranoid. Financial advisors told me I was making a mistake, that I should be in index funds, that I was missing out on gains. And you know what? For a long time, they were right about the opportunity cost. Silver sat at $15, $18, $20. For years, while the S&P doubled and tech stocks went parabolic, There were moments where I questioned myself, where I wondered if I was wrong, where I calculated how much more money I would have made if I had just bought Amazon or Apple or Google instead of silver. But for me, this was never a bet. It was insurance. Insurance against systemic crisis, collapse of confidence, currency destruction, brutal wealth transfer. I wasn't trying to get rich. I was trying to preserve what I had, to protect against the downside, to make sure that if the system broke, if confidence evaporated, if we got the kind of crisis that wipes out paper wealth, I would have something real, something that held value when everything else failed. And I genuinely believe we're moving toward an unprecedented global deflationary crisis, something much closer to 1929 than 2020. Not the short, sharp shock we saw during COVID, but a prolonged grinding deflation where debt becomes unpayable, where asset prices collapse, where nominal wealth evaporates. In that environment, tech stocks can drop 70, 80, 90%. Real estate can crater. Bonds can default. But metals don't. Metals survive. Metals hold value when everything else fails. Look at history. In the Great Depression, stocks lost 90%. Real estate lost 50 to 70%. But gold held its value. People who had physical gold could buy assets at fire sale prices from people who were desperate for liquidity. That's the wealth transfer I'm talking about, not getting rich, but being positioned to survive and then acquire assets from people who weren't prepared. That's why I hold silver. Not because I think it's going to the moon next week, but because I think it's one of the few assets that will preserve purchasing power through the crisis I see coming. And if I'm right, if we do get that deflationary collapse, the flight to physical assets will be extreme. The repricing will be violent. And by the time it becomes obvious to everyone, availability will be the constraint, not price. You wouldn't be able to buy silver at any price because there wouldn't be any for sale. Patience transfers wealth. Warren Buffett says, something I carry with me. The stock market is a device for transferring wealth from the impatient to the patient. I believe that applies to all markets. The people who panic and sell at the first sign of volatility transfer wealth to the people who understand the fundamentals and can wait. I can wait 10 years if I have to. And honestly, I don't think it'll take that long. I think the structural pressures are building much faster than most people realize. So would I sell now? My personal answer is simple. No, I only start considering selling silver when the gold-silver ratio gets closer to 1 to 30. Until then, I don't even debate it. That's not a recommendation. That's my rule. Everyone has different needs, different timelines, different goals. If you bought silver at $20 and you need the money, if you have debt to pay off, if you have life expenses that require liquidity, then selling at 110 makes perfect sense. You made a 500% return. Congratulations. That's an incredible outcome. But if you bought silver as long-term wealth preservation, if you don't need the liquidity immediately, if you understand the structural deficit and the supply-demand dynamics, then why would you sell now? Silver hasn't reached anything close to fair value relative to gold. The ratio is still 46 to 1. Historically, it should be 10 to 15. Even a conservative reversion to 30 to 1 implies silver has significant upside from here. And here's the other thing people don't think about. If you sell silver now, what do you buy? Do you go into stocks at all-time highs? Do you go into bonds yielding negative real returns? Do you go into real estate that's already priced for perfection? Or do you hold cash that's being debased by inflation and fiscal spending? There aren't many good alternatives, so even if silver isn't going to the moon tomorrow, it might still be one of the better places to be. Let's walk through the alternatives systematically. Stocks. The S&P is at 7,000. Price to earnings ratios are elevated. Margin debt is near record highs. Corporate earnings are being pressured by rising input costs and slowing consumer demand. Yes, stocks can go higher. But at these valuations, the risk reward isn't compelling. You're buying near the top of a bull market that's been running for over a decade with only brief interruptions. If we get a recession, if earnings contract, if the Fed is forced to maintain high rates longer than expected, stocks have significant downside risk. Bonds. 10-year treasuries are yielding, 4%? Maybe 4.5%, depending on when you're watching this. But inflation is running 3 to 4% officially. Real yield is barely positive or even negative. And that's assuming CPI accurately captures true inflation, which many people dispute. So you're locking capital into an asset that barely keeps pace with purchasing power erosion. And if rates rise further, bond prices fall. If rates fall, but it's because of recession, credit spreads widen and corporate bonds get hit. Bonds are not the safe haven they used to be. Real estate. Residential real estate in most major markets is at all-time highs relative to income. Price-to-rent ratios are stretched. Mortgage rates are elevated. Affordability is the worst it's been in decades. Commercial real estate is facing structural challenges from work, from home trends, and retail disruption. Office buildings in major cities are sitting half empty. Retail properties are being converted to other uses because traditional retail is dying. Yes, certain real estate markets and property types can still perform well, But as a broad asset class, real estate is priced for perfection and vulnerable to rate and recession risk. Cash. Holding dollars means you're deliberately choosing to lose purchasing power. The Fed is committed to maintaining positive inflation. Fiscal deficits are running over $1 trillion annually. The dollar might be strong relative to other currencies, but it's weak relative to real goods. Your cash buys less next year than it does this year. That's the intended outcome of monetary policy. So cash is a guaranteed loss in real terms. So when I look at that menu of options, when I compare risk-reward across asset classes, silver still looks attractive. Not because it's guaranteed to go up, but because the alternatives are expensive, risky, or structurally compromised. Silver has fundamental support from supply deficits and industrial demand. It has optionality if monetary conditions deteriorate. It has no counterparty risk if you hold physical. And it's still cheap relative to gold on a historical basis. That combination is rare. Let me give you a framework for thinking about this. Ask yourself 3 questions. 1, why did I buy silver in the first place? Was it for short-term speculation or long-term preservation? If it was speculation and you've made your profit, sell and move on. No shame in that. But if it was preservation, has anything changed about the fundamental thesis? Is the supply deficit smaller? No. Is industrial demand declining? No. Are inventories refilling? No. Then why sell? 2, what's my opportunity cost? If I sell silver, where does that capital go? Is there a better risk-adjusted return available? If the answer is yes, if you have a compelling alternative investment, then maybe selling makes sense. But if the answer is no, if you're just selling because you're nervous or because the price moved a lot, that's emotional decision-making, not rational analysis. 3, what's my time horizon? If you need the money in 6 months, if you can't afford volatility, if a 20% drawdown would cause you financial stress, then maybe your position size is too large. Maybe you should reduce exposure to a level where you can sleep at night. But if your time horizon is 5 years, 10 years, if you can ride out the volatility, then short-term price movements are noise. Focus on the fundamentals. One last thing. You don't have to believe me. Just watch what the big players are doing. Study the flows. Watch where institutional money is going. Watch what sovereign wealth funds are accumulating. Watch what central banks are buying. Do your homework. Question everything, including what I'm telling you. I'm here to help you think, not to tell you what to do. And remember, this is a personal decision. I'm sharing my perspective based on how I think about markets and how I position my own capital. But you have to make the decision that's right for your situation. If selling silver and taking profits gives you peace of mind, do it. There's no shame in that. Profits are only real when you realize them. But if you believe in the long-term thesis, if you understand the supply-demand fundamentals, if you're positioned appropriately for your risk tolerance, then consider whether you're selling based on fear or based on analysis. For me, the answer is clear. I'm not selling. Not at 46 to 1. Not when industrial demand is accelerating, not when inventories are draining, not when the derivatives bubble is this large, not when I think we're heading into a crisis that will make physical assets the only safe haven. I'll reassess when the ratio gets to 30 to 1. Until then, I'm holding. Drop a comment and tell me what you think. Do you hold silver? Are you planning to sell or keep stacking? What's your exit strategy? I read every comment and I learned from the community. Thanks for watching to the end. See you next time.